Good evening. Today is Tuesday. I believe it is October. It is October. It is April 23rd. If you can hear me, please type something in so that I know I'm not just talking to myself. And let's get going because I think I've got some pretty good opportunities for us. All right. So if I was to ask you, because you're all active traders, right? What is happening right now in our markets? And you can answer it many different ways. Let's make sure I show you my screen. There we go. So if I was to ask you what's happening today in our markets, what would you be able to tell me? Or what would you tell me? Going nuts to the upside. Liquidity rules trend for right now. Yeah, we're rocking, right? Things are really moving nicely to the upside. In fact, if we were to just take a quick look, I don't have it. Why would I do that? Let me get a chart for us because we're definitely going to be using charts. Let me get my chart set up. This is what I use, and it's, for all intents and purposes, free, cheap, gets everything done. You just saw the Dow, but I need to be able to see it with color vision impaired. I want it landscaped, and I want price labels. I usually also like it 6 months out because I want to see it most recently what's happening. Because it's been a pretty busy or fast moving market, I'm using pivot points right now for shorter term trades. I also use a Williams percent R, which is like a medium stochastics. It really is a good example of where big money is putting money to work. And come on, size, come on. Landscape it, give me something big. All right, so we're looking at the Dow. We're just to the point where we are going to be overbought. More importantly, if we look at the SPX, we are to the point where we are just about overbought. In fact, we went into it today. And if you look at the NASDAQ composite, the comp, we're going to see much the same thing. So it's interesting. If people were to talk to me, I would be telling you pretty simple. Bullish market. Better than expected earnings season. And that's really awkward for me to say right here from the start, right? Kevin, you don't know, we just had 1 week of earnings and already you're saying it's a better than expected earnings season, huh? My short answer would be, yep, definitely. And I still believe that we have a China deal bump. Coming in the near future. So, if I'm looking to place trades, what direction do you think I'm going? Of course, I'm bullish. I'm bullish, and that's the way I'm looking at most things right now. So, let's see what I can show you. I still have on my little play account. That's Keeves. I should do Kevin's. I still have a Boeing 390-400 July vertical, but you'll notice I added, for earnings coming up tomorrow, a 370 bull put. Excuse me, a 370 long put. I have Facebook calls that you could get into. If I was looking at new trades, in all honesty, $160. If I was looking at some new trades, I would be going long. I would be going long. So I still have a July 390-400 bull call, quantity 3 contracts, that today I added a May 24, 19, 370 long put for protection. The reason why I'm telling you this, even though it's a trade you can't necessarily get in right now, I'm showing you my thought process. I still think Boeing has upside opportunity. I think it'll be okay on its earnings. I think the worst case scenario that people put against Boeing is not going to happen. So I would expect it to at least get up to the 50-day at 394. Why 394? Because it's fallen from 446, because 394 is my 50-day simple moving average. Now 380 is my downside, but I would think that you might get a stop at 350, or more importantly 311. If it really hits the fan, 311 to the downside. So it's simple math. What I'm deciding to make a decision on, 394 to the upside, 380 to the downside. If it breaks 380, 346, but most likely 311. Maybe a stop at 330. So taking a look at my positions, pretty kind of amazing, right? Looking at my positions, it just came down to simple math. And I really should have added one more contract though. That, as I'm thinking about it, I'm seeing a mistake. No, I'm not. Never mind. So my cost basis was roughly $1,200, and my cost basis is roughly $1,200. And this one, $1,210 to the downside. On this one, I'm looking at $1,245. So simple math, right? We get back up to 394. I'm looking at this being worth about $9. If we get down to 330, I'm looking at my long put being worth roughly $40. It seems to gonna make it all work out. Obviously, I'd make more money to the downside. I have one directional long put contract against 3 directional bull call spreads. The most I can make right here, in all honesty, is $6.23, about $18. The most I can make on this one realistically is about 40. but it would cover each other. It's a covering or a protective strategy where I have one position that makes money on the way down, one position that makes money on the way up. I am literally looking at a 2 out of 3 scenario where I've got at least a position in 2 different possible movements of the stock that can make me money. I do have an open order, which I should cancel. And again, I'm trying to put the odds in my favor that off I go. Yes, my long put is a May 370. My long calls are a 390, 400 July, giving myself 2 opportunities, hopefully for earnings or a bump back on the long side, the long bullish side. Now, new trades, cheap trades, something that you could be doing for earnings on Thursday. If you were to ask me what I'd be looking at today, Ford. And if I went out to Ford on some options, I would be looking at Ford way out in time. I would be looking at most likely January 21. January 21 for $1, 99 cents or $1. I could have the right to buy Ford for 10 contracts to control 1,000 shares. It would cost me $1 a share. I like the risk to reward because if you go short term on a chart, in fact, I probably should take a screenshot of this, but earnings on the 25th, if you take a quick look at why this looks so attractive to me, it comes back down to my chart. In fact, why don't I go ahead and take a quick peek here. Look at the risk to reward on this one. You break even at $11. Ford, for all intents and purposes, is doing everything right now. Even its sales were better than the other sales for Honda, Hyundai, GM, Chrysler. I really like it. 1,000 shares at $1 a share. But it comes down to the chart. It comes down to the fact if I bring up Ford, I think I do got to go out a year. If I bring out a chart on Ford and go out a year, should be able to see it up to 13, but I'm just going to say it's at least 1150. I don't know how I would draw it this way, but the trend is to the upside. It's broken out right here. In fact, you know what would make it look really good? Let's go to FinViz really quickly. I like their chart. It'll probably do a better job showing what I'm trying to show. That upward trend line I am liking. And earnings should push it above the 950. $11, which is right up here, gets you back to a break-even trade, or at least a break-even, right? I think it can be at 13. So I would be looking at a new trade, an easy trade. I would be looking at if I was going to get into Ford, I'd be looking at the $10 strike for $1. 10 contracts cost you $1,000 and you're into Ford. If it goes back down to $750, which is $2.50 down, you will plan on dollar cost averaging for about 40 to 46 cents. A $2 drop, you can dollar cost average and cut the cost in half. And be in better shape. So for me, it could be a $1,500 trade overall. But for me, I would be looking to get into Ford. Earnings are on the 25th. And you have a great opportunity at Ford that really, it's a no-brainer. It is a complete no-brainer. Another no-brainer. Pretty sure it's in here. Mine did not get filled. So give me a second. Can't believe they didn't get filled. Dang it all the heck. Oh, I didn't realize that. I would not get out early on Ford. I would be running it it's a longer term investment. Literally looking to double my money at least. Disney 135 long calls. Those are already profitable. 1450, 1596. I would love to be in some Disney January 21. Leap long calls. Some already filled at 35. I might even go out to the 140s. It's at least going to get up to 150 in the near future. So if I was looking at another trade, can't afford that many, but a couple contracts here, can't do it on that many either. All right, hold on. Sorry guys, can't be doing a $96,000 trade. I personally don't have that much money. If you went out, snapshot analysis, 13,000. Don't want to do that either. Let's try that one more time. For a couple contracts at $2,600, $2,775, this looks very attractive. It looks very attractive coming out a couple weeks from now. To think Disney won't get higher in the near future doesn't make sense. But again, 153, it at least should run up to 150 in the next 3 to 6 months, giving you a full year to go. This one is an easy no-brainer for the near term. I would be looking at getting into Disney at a January 21, 140 price. Its earnings are still a couple weeks away. It's a longer term trade. It would be a pretty easy no-brainer for me to get it on in. And I did have a third one too. Glad we didn't get into Twitter. I think we called that one right. What was my third one I was looking at? Baidu. Now, Baidu is expensive. So Baidu, you're going to play a little bit differently. Baidu, you're going to play a January 220 because you need the stock to move. Currently, it's trading at 173, has support at 165. This one is going to be an in-the-money bull call. And with that spread, I would be looking at an even $5. A January 220, 165, 175 bull call. It really, don't know if I'd want to spend $5,000. Probably would drop that down to $2,000. More appropriately fits the account that I have open for you. But a bull call on Baidu really makes a ton of sense. It's an earnings play, but you're going out to give you a couple different earnings. You're giving yourself time. You know what? Because I'd half the dollar cost average, it's only a $35,000 account. In case I have the dollar cost average, I'd probably be looking at something like that, a 165, 175 bull call. I really like it because it's a one-to-one risk to reward. Maximum profits 1,000, maximum losses 1,000, plenty of time. Can very easily get above 175. It's an earnings play. Next earnings are on 5/16. You could possibly get out of it before earnings with a pre-earning run or any China bump. This one, again, is one that really looks good to me that I just want to call a no-brainer. It would be fun to get into. It would be one that would be kind of exciting. It's a one-to-one risk to reward. And again, it's playing the fact that things will go into play and be pretty good in the near future. But I'm setting a limit at $5 on that one. And if it fills, it fills. If it doesn't, not a worry. I can always find a better time to play it later on. So I ran into three that I was really liking today. Obviously, Boeing is there. That one's already in. Ford is one I would play. No questions asked. Ford would be a leap long call. $10. A January 21, $10 strike, leap, long call. I would expect on this one to double or triple my money. I would think that in the next 2 years, but more importantly, within the next 3 to 6 months, you could see Ford at least at 11, which would double your money, and more likely at 12 or 13, which would triple it. Be pretty exciting, be a good one to be in. Disney, no brainer on Disney. Disney is also, let me pull it in. And then obviously you guys are welcome to ask me any questions or for, all intents and purposes, just tear it apart. That is Ford. Don't want that one. I want. Did I not do Disney? So I'll put Disney in here as well. Disney, I believe, was a January 21 leap long call, and that was the $1.40, $140 leap long call. I will take a screenshot. And my last one is a Baidu in the money, full call at 165, 175. And I'm pretty sure I just took that screenshot as well. That again, I would, what the heck is that one? That's Boeing. Am I just not letting it get in there? There we go. But I'd set a limit at $5 and get it filled at that $5 price. And I'd keep it. I'd keep it good till canceled. Let it go for a while. It will get filled in the near future. Questions? What questions do you guys have for me? While you're talking about those questions, I'm going to find Disney again. Can't believe I didn't. I swear I did Disney. How did I not do Disney? Did not do Disney. That's so weird. Any questions or any comments about what I'm looking at and why? And again, I think I only had 2 in that one, right? Yep, snapshot analysis, there we go. No brainer on Disney in the near future. And I did try to get in at 135. It looks like I was not filled, but clientele was filled. And again, that is just a leap long call, a pretty no-brainer opportunity that they should be doing significantly better down the road. And there you go. Not every day I come up with 3 trades all at once. Comments, questions. Why hasn't Ford moved in the last year or so in your opinion? So it's actually been about the last 5 years, to go ahead and be honest with you. You can take it all the way back to 2008, the last 11 years. Ford pissed off the market. Ford said, you know what? We don't need no stinking bailout. We can do it ourselves. And they did it themselves. And because they did it themselves, they were not appreciated, and it was kind of a bummer. They blew it. They also expanded too quickly. Expanded into Europe, expanded into China, expanded into India. India and Europe suck nuts. China was doing okay. They had too many models. They're streamlining. The risk for Ford is if we have huge gas prices that go back up, then unfortunately we're in Ford in a position that says, hey, we're all expensive and gas is expensive and people will stop buying the bigger cars. So that is where they're at. They do have an electric vehicle and hybrid they're working on, but for all intents and purposes, it is not a, it doesn't look to be a moneymaker right now. So kind of a no-brainer. Not even thinking about it, not even worrying about it. But again, it's a longer-term play. It's what can I do longer term to see Ford take off. What makes it different now? It's already streamlined its productions. It's sold off Europe for all intents and purposes. It's streamlined China and the U.S. and India, and their profit margin is really taking off through the roof because they have cut off all the fluff for the fat. So I've already got this in, so I don't want it there. Not to mention a 6.28 dividend is pretty neat. Stock price analysis, could or should be trading at 18.20. This is not the right one. This is Disney. Hold on. Forget everything I just said there. Stock price analysis should be trading at least 10.52. Dividends 6.42% each year. Paid as a quarterly dividend. So you'll get roughly 15 cents. If I went ahead and moved over to FinViz, they think earnings per share this year is going to be at negative 0.07. Next year it's going to jump to a 10. That's what we're playing for right there. But more importantly, gross margins have jumped up to a 9.1. I really like it. I really like where it's going. It's where I would go with it. It's just where I would go with it. It's what I see, and I like where I think it's going to be in the near future. With coming earnings, would you start a trade on Berkshire B for the long run? How would you do it? Same question on Tesla. I would not trade Tesla. I think it'll go out of business before it'll really start making inroads into the automobile industry. Berkshire Hathaway B. Coming to a point, looking for a breakout upside to the 220-ish range. I just don't trade it. I don't know what to tell you. I just don't trade it. I was going to tell you I don't think it moves enough, but from 223-ish down to 190, that is enough. I would be in with a protective put, but I don't trade it enough to make a comment. Yes, your earnings per share this year triples, you know, 10 times in 5 years, but I think it is a good replacement for an index if you're going to do the S&P 500, but I do think with the expectation of the drop that it'll fare worse than the S&P 500 does. So I just I would struggle with it. I would much rather own a Baidu than a Berkshire B, to be honest with you. I'd much rather own an Apple because it pays a dividend. It is so diversified that I think it's a safe investment. But again, I would probably use it more as an index replacement. If you wanted to replace the SPY with something, I would be saying Berkshire Hathaway B would be the way to do it. But as much as I like Warren Buffett, I would have a hard time trading it. I wonder if it's even optionable. Anyone know? Is it optionable? Is Berkshire B optionable? And it is. I would just struggle with it. I would just struggle with it as a whole, and maybe it's a fault of mine there. So you would not sing me being a Berkshire B, but that is a fault of mine. That is not that's nothing to do with the stock. Why not just invest like Berkshire Hathaway instead of invest in Berkshire? I like that comment. Abraham, I'm trying to look at Berkshire B as a replacement for a kind of fixed income by using options. I would do it with Ford. Ford's paying a 6.42% dividend. So if you're looking for fixed income, why would you take something that is a pretty measly yield of Berkshire B? Says it doesn't even pay a dividend. That's not right, though. I'm pretty sure it does. Doesn't pay a dividend. So you know what? I would not use a Berkshire B for kind of fixed income dividend player. I would be using Ford at a 6.42% dividend payment. That'd be a good fixed income versus just shorting calls against it. Moves too much to do that. And yeah, company risk, a Ford company risk is significantly different. In fact, let's go ahead and let's point that out. Boy, they talk about pips here, huh? Where's the beta? No beta. That's surprising. The more I'm looking at Berkshire Hathaway, the less I like it, to be honest with you. Whereas you'll have a beta of 1.05. So Ford is 5% more volatile than the S&P 500. So I'm okay with that. Out of curiosity, I wonder what a Berkshire B would, or an A would be. That might give us a better idea. I would think that its beta is pretty close to the S&P. Beta is 0.79. B's are probably going to be at 0.94. So yeah, it might be 5% safer. 7.771 in toss, huh? I would say toss is wrong, Abraham, because I doubt the B shares would have a better beta and less risk than the A shares. So I would bet you if you calculated that, you'd probably be closer to a 97, which would be 3% safer, more safer than the S&P 500 as an index. But there's no way the B shares would have a lower beta than the A shares. Yeah, I would think that Toss is doing that somewhat wrong because again, you wouldn't see the B shares have less beta and less risk than the A shares. So that somewhere the numbers are not correct there. But again, I'm not giving you a really good, I'm not giving you a really good insight. I guess you know what? It's because it's so much like an index that I'm looking to beat the index, not match it. And I think you can do that better by picking the cream of the crop. You might wait a while for Disney to take off, but the longer you can wait and add more shares, the better you're going to be overall. But Abraham, very good intuitive questions there. I like them. I like them. I like them. I like them. Any other questions that I can answer for you that maybe I'm not answering right now for you all? Great questions. I should have this posted tonight. So if you go to My Hurley Investment, last night's and this night's will be there. I have been getting some of this posted on Facebook for people as well. But with that said, you guys have, if no other questions are out there, you guys have a wonderful evening, and I will look to see you from sunny California Thursday. Just as a heads up, you will see Kiev take care of my Monday night, next Monday. Kiev will be up for your market commentary. You guys take care. Have a wonderful evening. I will talk with you Thursday morning. Have a good one. Bye-bye.